Good day, ladies and gentlemen. Thank you for attending North Star's session of Meet the Managers. I'm Adrian Clayton. I'm the co-manager of the North Star SCI Managed Fund. I've been managing Regulation 28 unit trusts for 23 years, starting in 1999. I joined the market in 1995, and I was lucky enough to be introduced to the market and the dynamics thereof at an early age. My father used to trade gold in the 1980s. Our session today really revolves around asset allocation and our views of the asset markets, and hopefully we'll give you some insights into our thinking. Just in terms of the long-term track record of the funds we've managed, we've been runner-up or won awards across this fund over many years, and it continues to be a top-performing managed fund in its sector, and we'll talk to it at the back of the presentation. Asset managers really only have three reasons for existence. The first is to understand if a security or company is going to generate cash flows over time. The second is to understand the growth of those cash flows. And lastly, to try and understand what discount rate should be used to discount future cash flows back in today's present value terms. So, as I mentioned, we've got to understand a company's cash flow, try and work out what growth that cash flow is going to deliver, and then bring that cash flow back into today's money terms to understand what an asset is really worth. In theory, that's very easy. In practice, there are a lot of influencing factors that influence us. At the end of the day, we are human. So what does affect us? What do we think about when we're valuing companies? So I've put down various thematical themes or themes that are in the market currently that are really driving our focus when we're valuing stocks right now. Inflation, interest rates, debt, demographics, inequality and regulations that apply in the markets, and of course, valuations. So let's start with inflation. We understand what inflation is. It's the reduction of purchasing power over time. And simply put, we've shown coffee and how the price of coffee rises over a 50-year period. But inflation, by definition, is really too much money chasing too few goods. And an inflection point happened in inflation between 2020 and 2021 due to COVID. And we show here the graphs of a disinflationary world prior to COVID, with inflation dropping around the world. Even Japan had deflation. And then suddenly this inflection point happens in late 2020, early 2021, and we watch all those graphs escalating. Why is this important, and what has caused inflation? Well, as we mentioned, that by definition, it's too much money chasing too few goods. But the sources of this inflation are intriguing. On the one side, you've got a demand-driven problem. And we can look just, for example, at US households. Prior to COVID, in 2019, households were polled, and 44% of households between the ages of 25 and 60 could not afford an unexpected cost of $400 in any 1 year. Take the COVID crisis, the average person in a household got $3,200 that year given to them. Couples got $6,400. And if you had any dependents, you got an extra $2,500 given to you. That same poll run a year later, only 33% of households still concerned themselves with paying a $400 bill they didn't know about. So what we got was excess consumer-driven demand. The second point is supply. So we spoke about inflation having two components, demand and supply. With respect to supply, if you want to understand what actually happened with respect to supply chains and how they were broken, on an average year in December, Americans sit with 1 million cars of stock. In 2021, they only had 77,000 cars or vehicles of stock left. That's a dramatic difference to an average year, hence the price of cars rising. There's a third reason why we had inflation. That is excess money supply. $18 trillion of money supply exists in the US system. The Fed pumped in $120 billion a month of excess money into the system to stoke higher prices and demand. And then lastly, the fourth reason is that the Fed, together with the fiscus in the US, worked collaboratively to stimulate the system, and we saw that right around the world. Why is this important, though? What does inflation mean? Well, what we show here is in red US inflation, obviously rising precipitously of late, and against that, the earnings yield of the S&P. What is the earnings yield? Well, like any investment, think of a money market account. It has a yield on it. So too does the equity market. Investors demand a high yield from equities, as they do from anything else. When inflation moves higher, investors demand that yield to rise. And what we can see in 2020 is inflation has spiked, but the yield has not compensated investors. So three possible outcomes. Either earnings have to rise on S&P companies, and they're already on a high base in terms of profitability, or we have to see inflation drop, or lastly, we have to see the market correct. There is a possible fourth outcome. All of those happen collaboratively. The point we're making is inflation is rising. The market has not compensated investors appropriately.